So if you believe what Ben Graham said, Warren Buffett's teacher, that this horizontal line is fair value, and this wavy line around that horizontal line are stock prices, and you have a disciplined strategy to buy more than your fair shares of companies when they're below the line, and if you're so inclined to sell or sell short more than your fair share when they're above the line, the fair value line, market's throwing us pitches all the time. You just have to be cold.
Value investing has underperformed. Momentum underperformed growth, more to the point. Is active management in value investing in big trouble?
Well, that's a great question. Value outperformed the way, Morningstar or Russell defined it for a long period of time up till 2006. And then since 2006, the last 12 years, growth has outperformed by 5%. It's beaten the market by 5%. So people often ask, is value investing dead? And, I answer it this way, yes, no, maybe, I don't care. And and the reason is because it really depends how you define value. The type of value that's used when Russell or Morningstar define it really has to do with low price to book, low price sales stocks. And those are factors that have correlated with cheap stocks in the past. But our definition of value is different. We value businesses. That's what stocks are, ownership shares of businesses. They're not pieces of paper that bounce around that you put fancy ratios on. They're actually ownership shares of businesses. And so we value businesses and try to buy them at a discount. That's our definition of value investing. Both Russell and Morningstar put us in blend, meaning we're not low price book, low price sales investors. As Warren Buffett has often said, value and growth are tied at the hip. Growth is part of valuation. So if we were private equity investors, which is the way, we're going to buy the whole business. That's the way we value businesses, like we're going to own the whole thing. They don't buy whole businesses, private equity firms, based on low price book, low price sales. They're looking at cash flows.
Right.
And that's what we're looking at. What are the cash flows? How much are they going to grow? This is how we're going to value the business. That's what we do. And so it doesn't make sense that if you're good at valuing businesses and then can buy them at a discount, that should ever go out of favor. So if you believe what Ben Graham said, Warren Buffett's teacher, that this horizontal line is fair value, and this wavy line around that horizontal line are stock prices, and you have a disciplined strategy to buy more than your fair shares of companies when they're below the line, and if you're so inclined to sell or sell short more than your fair share when they're above the line, the fair value line, market's throwing us pitches all the time. You just have to be cold and disciplined to be able to take advantage of them, and that's really hard.
And you're still getting the pitches even when the markets, are valued at kind of near historic highs. Okay.
So we go in cycles, and we've had a good run. That's true, but we always have shakeouts. Just the nature of the beast. People get very emotional, and if you're patient, that was just the last 20 years. A lot of doubling and halving. So I think the world won't change. And the reason for that really is simply you can throw all the computers you want into this. People are people, and people don't change. And so that's really what we have going for us.